All right, what's going on, guys? So Terry James, your mortgage guy, coming to you. One of the things that I want to talk about today is simply going to be, as part of my mortgage minute that I mentioned earlier, just to go into more details and more depth, is the reason why it's important to eliminate credit card bills, loans, anything like that when you start to apply for a home, when you start to look for a home. The reason why that's so important is because the impact that those items can have on your buying power are absolutely dramatic. They're huge. Okay. And so, just taking a look, and I'll pull up some things I actually want to show you guys just so we're looking at some numbers. So for example, you guys know I like to use your basic numbers. So for example, if we're looking at your monthly income and let's say it's $5,000 a month, okay? So 5,000 gross income, of course, we're talking just base salary, $5,000 a month, okay? Typically for most conventional programs, we're able to go up to usually around 45% debt to income ratio, which, you can check other videos to go over that. But 45% of your gross income is what can be used, or what is our top end of qualifying. Usually Fannie Mae, Freddie Mac, those are typically the guidelines, 45% for your mortgage. So if you're at $5,000, you're basically going to end up being at around $2,250, I believe, at 45%. And so that's going to be your max total mortgage payment. Okay. And then once you start to get into that, you have to take into account your taxes and insurance. Okay. Now, this is if you don't owe any money to anybody else. We're just talking your only payment is going to be your mortgage payment. Now, keep in mind that we're not talking about, utilities. Remember, when you're applying for a mortgage, we're only talking about the debts that count against you are the items on your credit. So credit card, student loans, personal loans, collection accounts possibly. So anything that's on your credit, that's what we're referring to, okay? So let's say you don't have anything on your credit. Good job. Awesome. Okay. You did it. So there's no other items on your credit. So the only thing that's going to affect you is your mortgage payment. So taxes and insurance, I'm going to estimate just for the purpose of this is $500. Okay. So let's say you use $500, that $2,250, as I said earlier, which is basically 45% of your gross income, which we're using $5,000 for the purpose of this video. So once you deduct that $500, from there, we're going to be at around $1,750. Now, that $1,750, you can actually pull up a mortgage calculator. I'll try to put one in the link so you can actually calculate it yourself. So the $1,750 is what you're going to use as a principal and interest payment. With the mortgage calculator, you can easily punch that in. Say $1,750 is your payment. We're going to say a 30-year term. Interest rate right now, we're just going to say 5.5%. Rates are somewhere in that neighborhood, 6%, 5.5, somewhere around there. So we'll say 5.5. What that's going to get you, and if you have a mortgage calculator, like I said, I'm going to try and put in a link in the comment section. So if you have that, that's going to tell you what your max loan amount is, okay? So your max loan amount, if we're using these numbers, your max loan amount is going to be around $308,000, okay? At $308,000, if you're putting down 20%, your purchase price is going to be around $386,000, okay? So that $386,000 is going to be your max purchase price given this scenario of $5,000 gross monthly income, okay? And you don't owe any other credit debt. Now, we're going to take that same scenario, okay? We take that same income, same everything, same interest rate, 30-year fix. But now, at the end of that, we ended up with $1,750, right? But this time, let's say you owe just $200, just simply $200 a month in credit debt. So once you do that, your max principal and interest payment is now going to be not $1,750, now $1,550, okay? And once again, you put that into your mortgage calculator. You're going to have 1550 as a principal and interest payment, 30-year term. Put in 5.5% as your interest rate. It's going to give you a max loan amount, which you should probably end up is going to be around $272,000. Basically is your max loan amount. That gives you a max purchase price. Once again, if you're putting down 20%, your purchase price is going to end up being $340,000. And so the difference from just simply going from adding a $200 payment, the difference it affects you based on this scenario is 40 grand. So you're losing $40,000 in buying power just by owing $200 a month. And so what does that mean? You know, one thing I always talk about in all my videos, everything is about planning, okay? So as you plan to purchase a home, as you start to go through this process and you're purchasing, you're starting to look, you have to start planning. So if you owe, $5,000 or $10,000 in debt, and let's say that debt on a monthly basis is $150, $200 a month, $300 a month, you want to try and say, okay, maybe we make a plan to pay this off and then we work to qualify, because we're talking significant money between, $40,000 of buying power, you're losing out. So every payment that you have, you want to start looking at that and say, okay, if it's, $75, $200, you want to say, okay, well, what is the max payment on that? Maybe we work to pay that off first and then you look to purchase, or you look to buy. Especially in this market with the rates going up, your buying power is already being affected. So now the next thing is, if you can plan to pay off, maybe you only have, a year to go on your payments. Maybe you start doubling up on your car payments. Whatever the case is, you start working a plan to start looking at those options. And so, one of the things is that, I know that most people know that if you pay, well, some people may not know, but if you pay more than the minimum payment on debt, then that's how you start to pay your debt down faster. That's how you get things paid off a lot quicker. So if that payment is $150 and you send $200, then 50 of that is automatically going to start rolling towards the principal, because especially on credit card debt, even car payments, a lot of that is interest. And so if you make more than the minimum payment, and I know on car loans, you're able to send a payment to principal only. And so that's another good idea to do, is if you have a car payment, start paying principal only payments on top of the minimum, and that'll help pay that car payment down even faster. And so because that $500 is going to cost you significant buying power. And because in this market, you have to capitalize on your buying power. So, if you're close to paying something down, look to pay off your debt. I just want to show us, the difference, or basically how we're affected by as little as $200. Now, granted, of course, if your income is more, then that effect won't be as dramatic. For instance, if you do it on $10,000, it's not going to be $40,000, but I believe the difference is end up going to be like $25,000 in buying power that you lose. And so, the more money you make, the less impact. But at the end of the day, that your buying power is decreasing by simply having $100, $200 in monthly debt. So we need to focus on that when you start to look at buying a home. Focus on your monthly debt and seeing what can be paid off before you apply. And that's one thing that I know as a loan officer in this industry for so long, that's some of the first things I look for when people are having trouble qualifying is, well, what if we take this payment off? What if this can get paid? And even using like gift money to pay certain things off. Whatever it is, we have to get creative and look for those other avenues so that your buying power can increase, so that you can afford more home and get the home that you really want. All right. So hope you guys have found this helpful. Definitely make sure you hit like, share, subscribe, and leave me any comments if you have any questions or anything else. All right. Talk to you guys later.